What's up, everybody? Welcome into the Pursue Your Vision of Financial Freedom podcast, where we're going to try to bring you some life-changing information today when it comes to planning with the new administration on board. Financial planning, investment planning. There's been a lot of discussion around what's going to happen with new policies and all that. We're going to hit that today and hopefully get you some information that'll help you pursue and preserve your vision of financial freedom a lot sooner than later. So again, appreciate you joining on. Here's our agenda for today. This is my magical sticky note. So I know you see there, you can put them up all over the place. I could even have one on my head here, but that's not going to happen. This one's magical because it's like the Santa Claus movie from Tim Allen. You know, when he reaches back in the sleigh and there's no toys in there, and all of a sudden he pulls it up and there's all these toys, and he goes down the chimney and he's whipping out canoes and oars and all that, and just keeps coming and coming and coming. This is the magical sticky note that can do it. I only need one. Look at this. I just slide and it keeps giving me more information. There you go. That's my new innovation for the 2021 podcast. So I appreciate you joining on. All right. So what we're going to talk about. I'm going to hit on a quote from President Calvin Coolidge back in the Roaring 20s, the 1920s. Very apropos to what's going on right now. I think it's a good one to bring out. I'm going to look at a few charts from 2020. I think are very good to look at because obviously we all have been through a challenging time, right? It's just been incredibly challenging. And I think there's some great charts to look at. With us moving forward into 2021 as I look at the outlook for that. And how does a Democratic sweep in the Congress with the President, Joe Biden, how does that impact your financial planning? Historically, what does that look like? From investments, taxes, and all that. So I'm going to hit on that. I got some great charts you got to stick around to see for that. Also have our chief market strategist coming in via our YouTube channel for just a brief moment. With another one of our major research guys, Jeff Bookbinder. So you got to take a look at this. And then also, I'm going to look at some historical charts on personal and corporate income taxes and how that's comparing to what the Biden administration wants to do. And then, as I said, I'm going to get into some investment planning ideas on a general sense that you might be able to take away. And if you're working with somebody else, great. If you want to give us a call, we give you a complimentary upfront consult, and you can get some of the ideas more specifically from us that way as well, and how it may or may not benefit you, and it obviously has to be suitable and all that. And the last two things, and again, this goes with what we've been challenged with last year and still into this year, the coronavirus and everything, all the political stuff that's going on. It's just been crazy. Really, it comes down to this, in my opinion. You cannot bet against human innovation, human resiliency, adaptability. And when it comes time to times of distress, really the majority of all human beings step up and they're charitable. They want to help each other. I think that's going to continue on. It has. That's why we're still sitting here today. That's why I'm talking to you today. It's been the ability for us to adapt all this crazy challenges over the history of human beings. Otherwise, we wouldn't be here, right? So have that belief no matter what's going on out there. I really do believe it. And then lastly, to kind of calm us down, get us going into 2021. I don't know if you've ever seen the Sunday morning show on CBS, but they have do a bunch of different types of interviews and different topics they go over. But at the end, they always show, I just love it, is just a relaxing naturescape. And I've got a good one for you. So you got to stick around to the end. Get some good Zen meditation in as we move on for the rest of the week and into the rest of 2021. All right, let's go into my first thing I wanted to talk about. Calvin Coolidge. So he took over for Warren Harding. I think it was in 1923. He was the vice president at the time, coming right out of 1918 to 1920, the Spanish flu. 50 million people worldwide died. Way more than we have right now. But and also in the United States, is about 700,000 people passed away. I think we just crossed 400,000 in the United States. It's absolutely horrible. I just lost a client to it. It's absolutely devastating. It's just horrible disease. And then we were coming out back then out of World War I. Millions of people there died too. So you got that going on. Then we hit the Roaring '20s. But as Calvin Coolidge says here, nothing in this world can take place of persistence. Talent alone will not. Genius will not. Education will not. The slogan "Press on" is solved and always will solve the problems of human beings. That's kind of what I was talking about before. Adaptability, innovation, resiliency, charitable kindness in times of distress. I believe that. And I thought that was very apropos here, because what's interesting is our research group just released this chart about, politics aside, Donald Trump and the stock market on the Dow Jones over the last 4 years compared to historically other Republican presidents and other presidents out there. And it's the best return. Look at this. This is insane. And this is kind of crazy because I had this quote picked out. Excuse me here. I got to switch to a different shot. Let me get this up. Here we go. Move here. Sorry, my magical sticky note was going a little crazy, but it's okay. Anyway, here is this. So Trump's 4 years in office, the Dow Jones gained 56% overall, which came out to an impressive 11.8% return, which was the best for any Republican president since Calvin Coolidge in the Roaring '20s. He did his during his reign, if you will, the presidency there, his administration, 25.5%. Let me scoot this up here so you can see it. 25, and I'll blow it up even more. And I'll get out of the way. So 25.5% from 1923 to 1929, guys. So we're going to talk about this here and more, but we see a lot of good things coming. There's a ton of stimulus out there that has already hit. We got more being proposed by President Biden. If we get that and the vaccines start to take hold here and we see the curve start to drop on these cases and hospitalization, which I've seen in California and actually a lot of places around, that is starting to drop. If we get this, could we have another Roaring '20s? Technology, innovation, don't bet against it. I'm not guaranteeing anything here. Things can still go down. Anything can happen. Past performance is not a presentation of what's going to happen in the future, but I think we cannot give up hope here, guys. All right, let's look into these charts. I want to show you this as well for 2020. What I picked out a few of these. There's like 20 of them, but I'm just going to hit a few of these, which I think are extremely valuable for everything we've gone through. And I just want to make sure my disclosures are up here. I can blow this up, make this full screen. So now we're going to have a little bit more fun. All right. So these disclosures, I got to let this run for just a second. LPL's research group, and make sure it gets the last little thing over here. On that as well before I go into these charts. I'm going to start scanning through this. You may hear some noises and stuff, but let's get into this. The first one is the fastest bear market ever. So the S&P, from the time it hit an all-time new high on March 12th, 2020 was a date of the bear. It took 16 days to reach that bear market, which is a drop of 20% from an all-time high. So 16 days. That's the fastest ever. The next fastest was back in the Great Depression, October 28th, 1929. Is that crazy or what? But on the flip side of this, the positive side of this, and this is 2020, guys, the craziness of 2020. I got to go forward just a second. It is the largest reversal ever that we've had in the stock market on the S&P 500. It dropped from the all-time high, max pullback 33.9%. The average pullback's like 13.7%. The S&P 500, this blue line is the actual return that it finished at. So we went down 33.9 pullback, right? That was the pullback. And it recovered positive. I think it was the final number is about 16%. That is the largest reversal in history. So that just shows you the type of world and innovation. And again, the markets are, based on what I heard, are really anticipating innovation of vaccines, getting things back to normal. And that's where things have started to come back dramatically. I'll come back to myself. We lost about 22 million jobs at the peak of this, and then we gained back like 14 million. And our unemployment rate was like 14+%. Now it's back down into the mid sixes. We had a little bit of blip here in December, but that's due to was more shutdowns and lockdowns they had out there. But now I think we're starting to see a trend again from the numbers I've seen of cases dropping, hospitalizations dropping, as I mentioned before. If this takes hold and the stimulus that's planned, wow, may not be completely this year, but look out for 2022, 2023. Let's see, what was the other one? I wanted to see, not that one, not this one, that one. This was the, also, to note, this was the largest expansion since World War II that we had. It was 128 days. It beat the expansion from 91 to 01. That was the big tech run there too. But 128 months, guys. And then the length of recession following that was like 8 months there. I forget, we were out of this pretty quick. I think it was like 5-6 months or something like that. So definitely believe we're out of that. So that was another positive thing. Just again, the snapback on that. Scrolling. This is a pretty good one here. The average economic expansion may have years to run. The average after a recession, about 5.3 years. We were at 10.7. So we just hit a recession, although an abnormal recession because of the coronavirus. Do we get another expansion, another 5 years? That would give us that roaring 20s I'm talking about. Do we get 25% like Calvin Coolidge did? Again, no guarantees here on that. The other thing that was huge, just to give you a perspective, we threw the largest amount of fiscal stimulus ever at this thing. This dwarfs in comparison to the 2008 economic crisis with real estate, the mortgages, and all that. We had banks. I was at Merrill Lynch when this happened back in 2008. Oh, you never can have. Merrill Lynch will never go under, right? Almost did. Bank of America came in and bought them out, but we've thrown way more. Look at that, more than double, like triple the money at this situation. That's what I'm talking about, and there's more that they're looking to bring at it. Let's see. There's another one that was interesting on these. Look at this. Does history rhyme? Looking at, let me get out of the way, 50-year flu outbreaks. Every 50 years. This is put together by our research group, also Johns Hopkins University. Every 50 years we've had a major flu outbreak, a pandemic. Look at this. 1918, market went down 33%, global deaths 50 million. And then there was 675,000 deaths. That's what we were talking about. 1968, that's when I was born. I didn't even realize this. Market was down 36%, 1 million global deaths, and 100,000 in the U.S. So we've come back from that. Now we got COVID-19. The market hit about 34% down, 1.8 million deaths. We're now at over 400 on the U.S. that I saw. But just to show you, wow, every 50 years we've had a major pandemic outbreak. How crazy is that? That's just kind of weird. So that's the charts. There's one more I want to show you. It's down here. Is consumer came back fast. So this is just to show you, because everybody ended up spending money on the internet, right? They're at home cooped up. They're buying things, all kind of different stuff. We actually had and I'll show you some specific numbers here, but the consumer dipped dramatically right here. This was back in the 2008 recession, global or the economic recession there with the mortgages and all that. Look at that drop. And then bam, we're back above where we were, guys. So again, some more positive momentum that we're seeing there with this. So that's the major ones I wanted to show you for 2020, which a lot of bad things happen are still happening, but there's still a lot of things to be looking out for on the positive. Okay, let's look at this. I got to move myself on the other side now. These are 5 charts talking about, and this is the biggest question we're getting. It's hitting all our research group, and I'm going to blow this up even more. But should a Democratic sweep scare you, the markets, your financial planning, what to do? We'll take a look at this. So right here you got the year, the president. This is when the Democrats controlled the White House and the Congress all together, and the S&P index return. So there's been many times this has happened. And look, there's only 4 years that we actually had a negative return during that period of that year when they took over. So last time it happened, again, people are talking about President Biden, Kamala Harris, Vice President. Look at Barack Obama and Vice President Joe Biden back then. They did 23.5 and 12.8. Obviously, I know things are different. It's always a little different. But just to give you some perspective, also back in the 50s, I'm going to show you this here in a little bit. Taxes, income tax rates, much higher than where they were today. Corporate taxes, much higher than they were today. And what they're even proposing of increasing coming up. And I'll show you that in a little bit. So that's one chart. Let's see. Stocks do better if the president wins the re-election. This is interesting. 1950 to current. President wins re-election. They do 9.6. New president in office, 4.8. So you got kind of a interesting thing here. If President Trump had won re-election, they were expecting, historically it shows, to do better than somebody coming in. However, then when you got the Democratic all sweep, that shows a little different too there. So that's interesting. Here's another one. Let's see. Stocks do well under new Democratic presidents, and blue waves are normal. What this shows is the House majority. So this is a key thing with the Senate and the House. But the majority, this is interesting. So we got to go all the way back to, I'm going to look at what this talked about again. Stocks gained the first year. So this is their first year of presidency with when the Democrats bring the House and the Senate with them, and that's been the case. So if Georgia would have won, that would have been kind of an anomaly, because typically when the president wins and you've got the House, usually the Senate has always come with them. 6 out of 8 times the stocks have gained in their first year of presidency. Let me get out of the way so you can see this better. I'm going to go Invisible Man on you. Here we go. So look at this. Stocks do well under Democratic presidents. This is the S&P returns following the year after new Democratic president takes office. House majority back. You had to go all the way back to 1912. Woodrow Wilson goes all the way back to then. It was down 10.3%. Jimmy Carter was down 11.5%. Every other one, we've had a nice return. Average 11.9%. 75% of the time is higher. The other key thing to look at here, guys, is this. And this is what we talk about, a split Congress situation still potentially. House majority. Look at this, 163, 196, 91. This is the lowest ever when they've brought both the House and the Senate, where the House has had the lowest majority of Democrats over Republicans, only 11 seats. That shrunk. I think it was by 10 or 12, 13 seats. So there's some wave there with Republicans coming into the House. Now the Senate is now 50-50. So that the Georgia races that we had on January 5th, that got it to 50-50 with Vice President Kamala Harris being able to cast the final vote if there is a tie in that for certain things. However, there's some key things to talk about here that I want to show you right now from our, let me pull this up. This is from our chief market strategist at LPL, Ryan Dietrich, and then Jeff Bookbinder, who's our vice president equity strategist. I'm going to blow this up. They're going to talk about this real briefly. I'm going to let this run. I'll get out of the way here for a second and let you hear this, but it's some key points around what I've just been talking about. Let's play this right now.
Wave, and I'll talk a little bit on this one. Again, the most popular question we've received at LPL Research for the past 2 weeks has been to talk a little bit about the blue wave. We did talk about it last week, right? I mean, we focused on policy and some other things, but I want to take a look from the stock market point of view, because we've had the questions and, to be blunt, some concerns of if there's a blue wave, what could it mean if you have higher taxes and higher regulation, and could that impact, from an investments point of view? And we are sharing a chart on our YouTube channel, and I did a blog on it on lplresearch.com on Friday. Took a look since 1900. When you have a new Democratic president, so it's the first year in office, what happens? Well, what got me was they bring the Senate and the House with them every single time. All right, it would have been more rare if Georgia didn't come out the way it did to have a split Congress, because that's not normally what happens when you have a new Democratic president. But what got me also was it's a 50-50 Senate. All right, that's about as close as it gets, last I checked. But look at the House. The Democrats have an 11-seat majority in the House. That's the smallest majority the Democrats have had since 1876. Okay, so yes, there's a blue wave, right? But I think it's much closer. And we've talked for a while on this podcast about how gridlock can be good. You don't have too much extremes to the left or to the right. When you have those kind of checks and balances. We're going to talk about policy and Joe Biden's economic plan very, very soon. But I think that's something to be aware of. And then you just look at how stocks do, right? I mean, what do stocks do when you have a new Democratic president and both chambers of Congress that lean to the left? Well, 6 of the 8 years, stocks were higher and the average returns up around 12%. So all in all, what we're seeing this year, the response, the opening up of the economy, whether you agree with the policies or not, we think, the stocks are probably going to continue to go higher as this economy keeps opening up. I mean, Jeff, do you have any other takeaways on kind of the chart that we're discussing and the thoughts we're discussing right here?
The key point high level here is that the economic cycle matters more.
Yep.
Corporate profits matter more, and those tend to overpower the policy changes that you might see. So don't put too much weight on this. But certainly this study you put together, Ryan, should give folks comfort who are worried about the tax increases, the regulation, and some of those types of things.
And we call our podcast Market Signals, right? We're trying to find, quantified, factual data that shows us a potential path to where we're going.
All right, there, guys. So that's what I was talking about. Just some confirmation from our chief market strategist and vice president of equity strategies, what I was reiterating there. So, again, as far as the blue wave thing, I think I would not be concerned about that long term at all. Down the road, obviously, got to keep monitoring things, what's going on. So we have Congress, the checks and balances, and all that. But definitely. As you can see from them, reiterating what I was talking about there. All right, so let's see if there was any other charts I wanted to hit on here real quick. This was, difference between the Senate. This is the difference between the Senate when they had the Senate seats. So 0 right now. Back when Barack Obama and Biden ran very close to, they had a 0 here in 2009, 16 advantage, 4-8. So you can see last time we had a 0 back in 2009, 07, 09. That's when we had the economic crisis there, but then it bounced back up in 11. We had some good returns in there. So that is it on that. Let me look at the next thing I want to go over. Here's the last piece on the historical split. So just to kind of summarize this, if you've got a split Congress, let me move myself here real quick, which I think we really still kind of do with the Senate, and we got a closer gap on the House. This 17.2% when you get a split Congress, not official split Congress, but we're close, as they were talking about. Republican Congress, 10.7%, and then a Democratic Congress, 13.4%. So again, some more numbers to support kind of what they're talking about and what I've been going over. All right, let's talk about taxes. So we got tax increases being proposed by President Biden. They're talking about this tax increase. I'm going to blow this up, being the largest increase as a percent of gross domestic product, compared all the way back to Lyndon Johnson in 1968. So 1.53% of the gross domestic product. So you say, oh my God, this big tax increase. What does he want to do? Well, if you look historically at tax rates, this is going all the way back to 1950s, and I got this is actually income tax rates. Let me find the 50s. I had it up here before. Now I got to find it. 1973, 76. I'm going back into the 50s because that's the last time we saw these numbers, which is just crazy. Now it's going up. Bear with me here. I may have to cut this and redo it. Now we're going back down. Now this is better. So this is before, it's like Harry Truman, I believe. Yeah, here's 1952. Take a look at this. Tax rates starting out at 24.6, head of households 23, all the way. If you're making over 200,000 down here on the bottom, guys, let me blow this up. Do you see this number? 92%. So they're talking about raising tax rates on the higher income people, 400,000 above, from 37% to 39.6%. And then possibly a Social Security payroll tax on anything above 400,000, another 6.2%, basically 6.4 number, somewhere in that range. Half for the employer, half for the employee. But there's a gap between, because the Social Security payroll tax, that stops at like 137.9. And then above that, there's this, it would be a donut hole till you hit 400,000. So that's not anywhere close to 92% from what I'm seeing here. So that, to put things in perspective there. Then also, federal corporate tax rates. This is going all the way back to 1909. Again, this is courtesy of the taxfoundation.org. Definitely visit there if you want something. It's got a lot of great information. But look at the tax rates on corporations back in 1951. I'm just showing you on the personal side. We're talking 42% on profits over 25,000, adding a surtax on there, what they talked about, and then excess profit tax of 30%. So you can see, and they're talking about taking the. We got to pause here. We got to hold on a second. 25, but then it jumps to 42. They're talking about going from 21% up to 28. All right. So there might be some other adjustments there too. But again, if we're looking at comparisons, I don't see temporarily, initially, that big a deal. Longer term, we don't know yet. And here's some of that other stuff I was talking about. This is, again, from the taxfoundation.org. Great place, guys, to go to. As I've said here in the past, get your information. But he's talking about Biden administration put at 12.4%. As I mentioned, over 400,000. Talking about, I already mentioned this, increasing the higher income tax bracket on people making it higher levels. Some other things in here. But there are also some things that are good, possibly for folks, where they're expanding the child and dependent care tax credit from a maximum of $3,000 to $8,000, $16,000 for multiple dependents, and increasing maximum reimbursement 35 to 50% of that. And then you have the as long as economic conditions are there, they're talking about $2,000 to $3,000 for children under 17, providing a $600 bonus credit for children under 6, and also another one down here. Actually, also the child care tax or child tax credit would also be made fully refundable, removing $2,500 reimbursement threshold, the 15% phase-in rate. And then we have also, this is could be huge too. A $15,000 tax credit for first-time home buyers. Last time they had that was during the Great Recession. Now, there are some things here on the tax side of estate planning. If your estate is over $3.5 million and they got this through, they're talking about reversing that back from about 11.2, I think it is right now, that you can give when you pass away federal estate tax free. So couples, it's like 22, 23 million. But if they drop this back down to 3.5, that starts to bring in a lot more people out there. I know a lot of us aren't there yet, but some people are. And if things grow, we could get there. And that includes life insurance, cash, your properties, IRAs, 401ks, all that kind of stuff out there to impact it. So those are some things estate planning wise we're going to have to focus on with clients as well coming up here. But what my point was here is that everybody's talking about the tax increases, but they're also going to spend money when they tax, if they're going to do it. They're talking about spending $7 trillion over the next 10 years. Focus on healthcare, climate infrastructure, education, higher education, housing, Social Security, and family paid leave. So you got the flip side where you're going to tax more. Could be one of the highest tax increases ever from a gross domestic product, but then they're going to spend that money, which can create jobs potentially, right? And out there. Again, you cannot bet against other innovation. There's all kind of innovation that's going out there. Doesn't mean it'll impact everything out there. So that's what we got to look for. But these are the stimulus checks. You know, it's a $1.9 trillion they're trying to get out here right now, which is an additional $1,400 as it stands to people for a stimulus check, depending on your income. And it's going to be based on what I've heard, the same kind of cutoffs as before. I'm not going to go into all that here. I'm going to have a separate video on that. But that's coming out. And I talked about the tax credits and all that. Okay, so how does the impact on corporate earnings? With this, we see the consensus estimate last year was 132 earnings per share. 2021, it's 162. If we get the tax hike, they're talking about this drop in impact down to about 146, or have about a 5% impact on corporate earnings overall. And then if another thing that the Biden administration could do is they could actually take away the China tariffs or reduce them, which then that could boost corporate earnings back up again there. So that's a potential positive on the other side. So what do we see for growth? Earnings overall, about 22% in 2021, and then we see more in 2022. But that would get us back to where we were prior pandemic if we get this 22%. However, what we do see is our research group sees emerging markets, Japan, Taiwan, South Korea, other Asia areas, China doing like 30% earnings growth. So we are definitely with our clients looking to shift some assets here over the few coming months more into some emerging markets and that as well. I had this up here. This is an interesting thing. A final thing on taxes, then I'm moving on to some other investment ideas that we can look at. Tax ranks when it comes to corporate taxes, individual taxes, sales taxes, property taxes, unemployment insured taxes. These are the top 10 overall ranked states, lowest out there. So if you're looking to retire or you're already getting already retired, say, hey, I'm thinking about moving. Here are the states you might want to look at. Again, courtesy of our taxfoundation.org, Wyoming, South Dakota, Alaska, Florida. That's why a lot of people are moving to Florida. Montana, New Hampshire, Nevada, Utah, Indiana, North Carolina, Texas comes in at number 11 down here. So think about that. Even land values of people, and you're starting to see a lot of people moving out of California, New York, New Jersey, from what I've seen of numbers. If they're moving into these other states, Texas, Arizona's, Florida's, think about the potential land value there too on that. Okay, here we go. This talks about some strategies. I want to see if I want to show you one other thing first. No, I don't want to show you that. So we'll get into this first. So we're going to look at our global outlook here in just a second, but just to put this in perspective, when we are planning for our clients, we use what's called a bucket strategy. And there's different versions of this out there and so forth, but we like this strategy. And depending on your own situation, this all varies and stuff like that. But what this states is we look to see, all right, when are you going to retire? How close are you from, or how much are you going to need in retirement? What are your current income sources? This is kind of all this bucket one money here. How much Social Security, pension, other income you're going to be getting, dividend income, all that. And then we say, all right, if depending where you are prior to retirement, we start breaking money out in these other 4 buckets here. So money you're going to need within 1 to 7 years, and then 8 to 17 years, and then money you're really not going to need for a much longer period of time in this bucket 4 and 5. And what we try to do is set up portfolios where you've got enough money in buckets 2 and 3 that are going to carry you through your major first spending years of retirement, right? And those are going to be all more conservative assets. And there's a lot of different things we can do with that. And if you want to know what we do, give us a call. We can go over these type of things. And then we get into bucket 4 and 5. This is money, growth money. We do some that has what's called pursuing growth with downside protection in various formats. There's pros and cons and considerations you have to think about there. And then we have bucket 5, our treasure hunting bucket, which is really we're trying to find, like the next great innovation out there, the next Amazons, Googles, whatever you want to do. Or we're trying to really outperform the market. No guarantees of this. You can lose money. It's very high volatility. But here again, like technology is our favorite sector still in our global outlook in this. So that would be one we're still focusing on in there. But let me show you this as well when you start breaking these out. And then I'll give you our final opinions of what's going on. So here is kind of some ideas in this when you start looking at the buckets. So you've got cash, bank, CDs, fixed annuities, fixed index annuities, bonds, variable annuities, mutual funds, stocks. There's also real estate you can lump in probably in this category in here. There's called structured notes that banks will issue that are similar to bonds and variable annuities, mutual funds, where they have upside potential tied to markets, and then they have also you can make money on the downside, all backed by their claims paying ability, their company, the bank. It's not FDIC insured or anything like that, but you have that in there. And there's also insurance companies that do similar things. So this would be that bucket 3 money inside of here. Right in this category, this is bucket that 4 or 5 money out here, which is more that long-term growth. And then bucket 1s and 2s are here. This is more the safer money in here. That's where you'd put that type of money. So again, feel free to contact us. We can show you things there as well. But let's go into the official global outlook so you can see this. And then we're going to wrap this up with that relaxation video session. You're going to love it. I'm telling you. Get some relaxation here. Take a look at our global outlook here. We definitely like stocks over the bond category. See the S&P. Doesn't mean there's other sectors like technology and stuff that could do better, but just S&P in general finishing around 3,850 to 3,900 in 2021. And then 2022 looking for an increased target over that as well. We see the 10-year Treasury finishing about 1.25 to 1.75. That was all the way under 1 down to like 0.5, 0.6. Now it's moved up to about 1.1. So we could have some, when you get a lot of this stimulus that could come through, we could see that really pressing through and driving up interest rates possibly there as well. Equities remain overweight. Talked about that. Biggest risk obviously could be this COVID-19, right? If a variant comes out that's not being helped by the vaccines or whatever and continues to lock down, that could be a big risk there. And then maybe, obviously, there's other things that are out there we can't predict that could happen. You just don't know. Let's see here. Cyclical value stocks we like. Moving a little bit more from growth to value. Again, that balanced approach. Talked about emerging markets. We like that. And then our bond side, if we do have bonds, is going to be mostly underweight in treasuries, really short to intermediate, because if interest rates start to rise more, your value of your bonds can drop the longer your maturity is. So we're focusing on more short, intermediate, high-quality bonds. And here's some of the sectors I talked about. Let me get out of the way so you can see more of this. Emerging market equities, growth equities still. We like healthcare, materials, technology, and the fixed income mortgage backs. Event driven. That could be like IPOs type stuff in there as well. Another thing that's come out in this past year is SPAC, special acquisition companies, where they're taking private companies public from an already public traded security type situation. So that could be kind of an alternative event driven type thing there. We're not recommending anything here right now on that, but just giving you some ideas. But overall, again, positive on stocks. Bonds were negative on especially the longer term bond, but short term, just really not much movement we see, and cash is neutral. If we get increase in cash, that could obviously raise up your savings rates, which I'm sure everybody would love on that. Let's see here. Lastly, our market forecast, 2020 market forecast. I talked about this here already, but GDP, United States, 4 to 4.5%. Developed outside of the U.S., 3.75 to 4.25%, and then emerging markets, again, here's the theme, 5 to 5.5%, and globally 4.5 to 5% on that. So let me pull out of that and then have some comments here lastly. So when it comes to market timing, I do not like to market time I try to do maybe with a little pieces of the portfolio, but for the most part, it is very hard to do that. You're really betting. It's stacked against you pretty much. As you can see right here, this is March of 2009 to 2008, or March 8th of 2019. So 09 to 2019, right as we were getting at the bottom of the horrible Great Recession. A lot of collapses going on, craziness. And you were saying, oh my God, I don't want to invest in the market anymore. I'm going to sell out. Well, if you did that, the problem is usually the bear markets, as we showed you before, they don't last very long. They're on average probably about, I think the recovery somewhere around 5 to 6 months, somewhere in that range. But if you stay invested through this whole period of time and didn't go in and out and try to time the market, you would average 17.5%. This is based on S&P 500. If you missed just the 10 best days, guys, 10 best days of the market out there, you would have dropped your return dramatically all the way to that 12.1%. I'm looking for a place here to come back on the screen with you. Here we go. And then if you had missed the 20 best days, you only did 8.6%. And then lastly, the 30. So you're talking 30 days out of 10 years. A lot of time, you average 5.6%. Unfortunately, see a lot of situations, a lot of situations that happen like that. And that's why, again, you cannot bet long-term, in my opinion, against human innovation, resiliency, adaptability, and the ability that we're going to take care of people if things are in time of distress. So if you've got money that you're looking at long-term, this bucket 4 or 5 money, I personally would not be trying to market time that portion of it. Maybe you got a little tiny bit you want to speculate with in the bucket 5 here, fine. But overall, we believe long-term things are going to be still going good no matter what's going on right now in this crazy times that we had. So if you want to get any kind of, again, review, financial complimentary plan, give us a call. This is give you just a quick look. We set up balance sheets, net worth statements. We look at your retirement cash flows, all kind of things in here that we put together for our clients and looking at what is their success rates and stuff that they might be looking at in their portfolios. We can make changes on the fly with our new software that's coming out, has been rolling out. Best software I've seen in over 29 years that I've been doing this. So with that being said, I am going to now bring out the video relaxation. I've said a lot. Hopefully this helps out what we've been going over. But let's take a look at this. I'm going to jump on here with this for just a second, and then we'll release it to where you guys can just relax on this. Where is my shot here? Here we go. This is the one I want. Or no, I want to do an overlay with this. Have a spectacular rest of your week. I thank you for joining on. And until our next video, we'll talk to you later. Thank you.
Too many days in the darkness without a glimpse of the light. Running tired and broken and scared, but I swear I'll never give up the fight. I see you broken and beat, head pulled down over your eyes. Every part of you wants to surrender, but darling, you were meant to survive. With every star